Hi, everybody. It's Eric Nuttall at the Ninepoint Energy Fund and Ninepoint Energy Income Fund. Thank you for joining. This is the second installment of the Ninepoint Energy webinars. The purpose of today is singular in nature, and that is clearly dominating the market today are fears about a recession and the impact on oil demand and inventories and ultimately price. We've seen energy stocks dramatically sell off. We've had the worst sell-off since March of 2020. And so we wanted to bring to you institutional quality of information. We couldn't find a better speaker in the entire planet to help address the concerns about recessionary fears, oil balances, and whatnot than Amrita Sen of Energy Aspects. We use a number of consultants for helping us assess the energy macro. Amrita's emails Monday mornings are the first one that I look out for. So I'm extremely fortunate, we're extremely fortunate for Amrita to share 30 minutes of her time with us to go through what exactly does or could a recession mean for energy or oil demand? What does it mean for prices? Is it thesis changing for our thesis that we're in a multi-year bull market for oil that's going to last 5-6 years and whatnot, ending in materially higher oil prices? And then I'm going to conclude with what it means for energy stocks, and we're going to have a 10-minute or give or take Q&A. So Amrita, thanks so much for joining us. The floor is yours.
Thank you, Eric. Very kind introduction. I'll kick it right off. Look, we keep getting asked about recession pretty much every, I was going to say hour, but really every minute these days from our clients. And I understand where the fears are coming from because we are at such elevated price levels. You know, we are well above $110 on Brent, well above $100 in general on oil prices. So I understand why people are worried about a correction. But I completely agree with what you've just said. This is a structural bull market. This isn't cyclical. Doesn't mean that if and when we do go into a recession, prices don't come off. Even if they do, our view and very, very strongly based on supply demand analysis and quite a few detailed econometric models is that we find it very hard to see how oil prices will go below $90, at best $80, simply because the supply demand gap is so large today. And I'll just come on to some of the numbers in a second, that we just will not see prices go and test the lows that we have seen in past cycles. So talking about the recession, let's start with that. A couple of things is, first and foremost, the fear very much and rightly so coming from the US Fed raising interest rates. But what I would like to highlight is that in the US, it's a very, very strong labor market, first and foremost, which does mean that overall consumer spending, it might buckle, but it's unlikely to break. Our latest modeling, particularly around the US gasoline side, actually shows employment as the biggest driver of US gasoline demand, much more than GDP. And, you know, I'm sure you've seen this in the past, like a lot of the analysis, it's pretty simplistic in kind of showing GDP growth. There's an income elasticity, right, of 0.5, 0.6. So for every % increase in GDP, you get, say, gasoline demand growth of, you know, the multiple is about 0.5. But the latest work that we've done actually shows you that it's employment rather than GDP. Over the next 18 months, we find that the large kind of increases in retail gasoline prices could lead to a 2% decline in gasoline demand. However, the increase in employment that we've seen over the last decade actually leads to a 4.2% increase in demand, right? So essentially, it nets off the decline in gasoline demand that we should see from higher prices. So I think that is the first thing I'd like to highlight, that some of these elasticities have changed. And most importantly, I think one of the fascinating things we are seeing is a lot of these price correlations that we've seen in the past, where at current prices, forget the fact that crude prices are where they are, above $100. If you look at diesel and gasoline prices, they are, you know, $70, $80 above where crude is trading because we have a huge refining bottleneck. You could have said to me, Eric, that, you know, these prices, you know, surely there's demand that's coming off. In the past, yes, at these price levels, elasticity does kick in where you start to see outright demand declines, not just lower growth. But there is so much pent-up demand right now still, because we are coming out of COVID, that we just do not see the reaction that we should have seen at these price levels. So To give you actual data, so far, gasoline demand is about 5% lower versus 2019 levels in the US. At current retail price levels, that should have been double digits. So clearly, again, goes back to the first point I highlighted about employment being the biggest driver, and the second point about there's still so much pent-up demand that some of these price increases are being absorbed a lot easier. And one of the measures, and we wrote about it today in our weekly note that you were talking about as well, if you look at US household debt as a percentage of total assets, or the one I like to reference the most is household debt to service ratio. That compared to 2008, 2009 is absolutely tiny. Especially for the bottom 90% of the economy, yes, mortgage and mortgages tend to be the dominant liabilities, right? That accounts for 2/3 of all debt. But interest rates on that debt largely tends to be fixed. And that's why we don't expect a sustained increase in market interest rates to move the debt to service ratio much above 10%. Right now, that debt to service ratio is around 9%. And if you go back to 2008, the 2008 crisis, that was well above 13%. So I think that's the big difference this time around, that the debt burden is much, much lower. And we do have it's a stronger economy, a stronger consumer sector. It doesn't mean that there's no pain. Of course there is, particularly around the low income levels, but we are seeing very strong growth still in that mid to high income levels, which I think will keep consumers kind of humming along. It doesn't mean it's going to be super strong growth, but worries that we're going to crash lower. I've heard price expectations of $40 or lower. We just don't see that happening. So that's much more focusing on the US side. But the bigger impact, I think, and I think this is being really underappreciated right now, is Asia. I was in Asia just over a month ago. This was my first trip in 2.5 years since COVID. And you have got to go there to see just how strong the demand recovery is. Indonesian demand is 40% above 2019 levels. Thailand, South Korea, even Japan, which is structurally a declining economy because governments are subsidizing prices. This is the other thing. We can talk about it if we've got time later on, that our consumers even actually seeing the price levels which are at the pump. A lot of countries are either, including the US, either just handing out checks or reducing taxes or just outright subsidies. Even in Japan, you've actually seen gasoline demand go back above pre-COVID levels, which really is unheard of in a kind of structurally declining economy. And all of this is happening with China not even really roaring, right? And we've just started to see China open up. Shanghai, the factories are starting to open up. And the reason we believe, and we are, by the way, factoring in a mild recession in our numbers for next year, Europe and US mild, Europe not so mild given the energy crisis we are in. But even with that, we have global oil demand growing by 900,000 barrels per day year on year. We are by far the most conservative on the street. Most people have 2 million barrels per day-ish oil demand growth. I can absolutely get you that number, no problem. We are being extra conservative. We've almost kind of killed a lot of industry in Europe because of the energy crisis, but we still get close to 1 million barrels per day of demand growth, even with Europe declining by 400,000 barrels per day and US declining by over 100,000 barrels per day, because all of the growth is going to come from Asia. China, the year-on-year growth you could see from China is enormous. Chinese demand was down by over 1 million barrels per day in April and May of this year. The most important thing for investors, I would say, to watch out for is around the October period when China has their 20th Party Congress. That's when we are expecting Xi Jinping to come out and discuss kind of the next phase of their zero COVID policy. He's not going to abandon that overnight, but there is a lot of pressure for him to ease some of these measures. You're already starting to see some of that come through. And this gets a little bit niche, but I will highlight this. A lot of funds and a lot of kind of macro investors email us, and they have been emailing us and saying, oh, but naphtha and petrochemicals are really weak. This is a sign of a recession. No, I completely disagree. The reason naphtha and petrochemicals and LPG have been weak is because China has been shut down. It's not because there isn't demand. It's because China can't get people to the factories to produce products, or consumers can't go out of their houses. And guess what happened on Friday last week? Naphtha turned back into backwardation, basically very clear sign that China is starting to open up. And for anybody kind of looking towards naphtha as kind of a leading indicator for a recession, I'm hoping some of those fears have been allayed, that this isn't, oh, China's going to implode and that's why petrochemicals are really weak and that's why naphtha is in contango, but very much around the kind of COVID restrictions that we were operating in. So I really do want to stress that regardless of your view on the US, and like I said, we've already pushed our US numbers very, very low, and Europe as well, to kind of make it much more of a look like the base case. At the very least, you're going to get strong growth out of Asia. And that's going to carry us that even with under 1 million barrels per day of demand growth next year, we've got stocks drawing. And we are drawing stocks from levels where you really can't draw stocks, right? Like it becomes a moot point whether we are talking about a 200,000 barrels per day stock draw or a 500,000 barrels per day stock draw, because again, we just don't have inventory to draw down. I think that is at the heart of where we are. And if you think about it, we've had all these recessionary worries. China's barely back into the market. We've lost some Russian production. I'll say this, that we had expected Russian production to drop by now by about 2 million barrels per day. It's come in at about 1 million barrels per day. So arguably, we've not lost nearly as much as expected. And yet our balances are still as tight as they were because the unplanned outages elsewhere, Ecuador being the latest one on the list. And really, the biggest issue is the lack of spare capacity. I cannot stress how little spare capacity OPEC Plus have, including Saudi Arabia. If you look at Saudi exports, not production, but exports, they've been pretty flat for the last 6 months. And our kind of relations in the kingdom with the minister and around the region as well very clearly point to this, the lack of spare capacity. So even if you said to me, Eric, that, oh, by the way, demand, let's say, is going to be flat year on year next year, it's not going to be up 900,000. I'll tell you that the problem is we need demand down by not 1 million, not 2 million. We need 3, 4, 5 million barrels per day of demand declines to be able to balance this market on a structural basis in the medium term, right? I'm not talking about just like on a quarter basis. And I think that's really where the challenge is, because the elasticity of oil is very, very, high, or it's very inelastic is my point. If you go back in history, like go back all the way to the 1970s, it's a very interesting chart to just see when has oil demand actually declined. It's amazing to see it's only happened 3 times, including COVID 4 times. Twice in the 80s, late 70s, 80s, obviously with the Arab embargo and everything that was going on. Once in 2008-09, which was the great financial crisis, and finally COVID. Weirdly, oil always manages to grow, even when you had the 97 crisis in Asia or the 2000 and kind of early 2000 dot-com bubble. And when it grows, it always manages to grow by over 1 million barrels per day, more or less. Even 2011 to 2014, which, by the way, was absolutely a recession in Europe and in the US, we had global oil demand grow by over 1 million barrels per day every single year, and oil prices average $130. And that's kind of the scenario we are thinking of, or we are factoring in next year. And this is why I keep bringing up China, because if China manages to gradually open up, which is our base case, a big part of the inflation fear in the West and a big part of what's driving the kind of recessionary fears is actually coming from supply chain bottlenecks. Easing those supply chain bottlenecks will go so far in reducing inflation, and which will allow the economies as a whole to absorb higher food and energy prices. I think that's what we shouldn't underestimate, that the supply chain bottleneck issues are intertwined with the energy and food crisis that we are seeing. We're not here on inflation just because of energy and food. So that's why I keep going back to China. And kind of just wrapping up the kind of elasticity point, I'll highlight one thing, which is April 2020, COVID, 97% of global industrial production was shut in. None of us were traveling, right? Yet oil demand only fell by 20%, fell by about 20 million barrels per day to 80 million barrels per day. The whole world was shut. That's how much oil we still consume, right? Forget all elasticity metrics, just look at the most recent one, which is April 2020. And that kind of gives you a good indication of how inelastic oil demand is. So like the point I'm trying to make is that, yes, we are factoring in a recessionary environment, but it doesn't mean that A, oil demand is going to crater, and B, even if you said to me we're wrong, oil demand is going to be flat or even declining, I'll go back and say, we need a lot bigger declines given, inventories are, if you look at the US, if you look at Europe, we are pretty much at tank bottom levels in various parts. And this is with record SPR that's come out. The SPR will end around October. The EU embargo for Russia is going to kick in 1st of December for crude, 1st of February for products, which will release millions of barrels of, again, additional Russian oil to find new homes. And you basically have China reopening. So if anything, we think kind of the 2023 strip is undervalued. The recession is in the price. And the kind of supply demand dynamics in an environment where spare capacity is so low really should lead us to much, much higher prices going forward. Even if, right now with the kind of SPR and with the recessionary fears, we can hover around these levels for some time. But ultimately, the trajectory and the only balancing mechanism has to be prices have to go up to a point and stay there for a while for demand to really get destroyed. And I don't use that term lightly. Demand destruction is you and me going and buying an electric car and never driving a petrol car again. It's not us not driving to get milk, right? That's demand reaction rather than demand destruction. And I think that we will absolutely need that to happen, but that takes a long time. So I'll end it at that, and I'll turn it back to you. And then, of course, I'm sure there are questions.
That was a wonderful summary, and that we've got a lot to unpack from it. So I've been running with the acronym for FEAR because fear for an investor is so destabilizing because it shakes your conviction. And so I've been running with the acronym like false evidence that appears real. When we look at real-time indicators like time spread, so like the premium for what's being paid for a barrel today versus a month from now, it's going up. We look at, I just used Kepler data this morning to update our work on global inventories. We just hit a new low or deficit relative to average levels. Here we have you modeling recession in many parts of the world next year, and inventories continuing to decline from already low record levels. And so to your point, I want to talk about price. So Energy Aspects has been one of the most accurate callers of the oil macro and oil price, in my opinion, over the past couple of years. Can you speak to how you view the cycle going forward? How many years of a bull market do you think we're in? And ultimately, I believe you're modeling $125, $130 oil next year. So can you just talk about what, as an investor, your base case expectation is for the next couple of years for oil?
Yeah, sure. I mean, look, and thank you for acknowledging that. I mean, we call for $100 plus oil prices between 23 and 26, pretty much from 2018 onwards. And that was absolutely based on underinvestment. We cannot expect to produce oil if we are not investing. We are putting in about $400 billion right now in upstream capex, of which at least 25 to 30 is actually increasingly going to green energy. Because a lot of the international energy companies like BP, Shell, and so on, 50% of their capex is going into renewables, right? We need, on our calculations, a minimum of $520 billion to hold production flat at 100 million barrels per day. Today, demand is already above 100 million barrels per day. It's around 101.5. But again, let's simplify it. Let's just say we need enough capex for 100 million barrels per day, and we are falling short by over $100 billion, if not $150 billion. And the problem is, this has been going on for 8 years. Usually we see 4 or 5 year cycles. We were, obviously, initially it was shale that killed the back end of the curve. We just didn't get investment. That then morphed into ESG kind of fears and metrics kind of becoming the biggest driver. Then we got hit with COVID. For me, and this is why I'm a very firm believer this is a structural thing, and I would say this is probably even a 7 to 10 year structural story. Every meeting, I was in Canada, in Calgary just 2 weeks ago, and in the US, just meeting with oil producers. these are prices where every single one of these producers should have said to me, yeah, we're adding rigs, we are adding wells, anything of that sort, right? Either they said to us, we can't find people, and the steel waiting times have gone from 10 days to 180 days for even those who want to invest, or the CEO remuneration now instead of being production growth, is now tied to ESG metrics. Yeah. So this for me is the biggest worry, and I'm not necessarily saying it's a pretty picture out there for kind of the world in terms of the energy balance, but this is where we do need to get really real awareness out there that global energy consumption, like if global economic growth is happening, and particularly led by emerging market, global energy demand is going to continue to rise, and we are not investing nearly enough in alternative energies, and we're pulling away from fossil fuels, the numbers I just gave you. And yet at $120 oil prices, I don't have a single CEO saying to me, yes, we are investing a huge amount. There's some going on. That's the problem. So I still don't see how this CapEx cycle is changing. It will, and again, a lot of the CapEx increases we've seen this year, by the way, 15 to 20% is just getting absorbed by cost inflation. So I believe the CapEx cycle will ultimately change, led by the national oil companies, say Aramco and ADNOC, and they are starting to do more. The problem is it's not a light switch, right? By the time all of this comes online, yes, by 25 we get a little bit, but it's really 2027 that some of these big projects start to come back online. But that's good 5 years away, and even so, by that time, the amount of demand growth that you're going to need to service is going to be even higher.
Yeah. Like I look at it, we had Saudi Aramco say, well, we're going to add 1 million barrels per day of capacity, but it's going to take 5 years. So I think, okay, 5 years from now, we've got demand growth of about 5 million barrels per day. We've got U.S. shale, 2 of the big basins flat to declining. We're now relying on the Permian to try to meet global demand growth, given that the super majors aren't spending enough. You touched on a very critical theme that I want to go back to, and that is OPEC spare capacity. I had the unique privilege 3 weeks ago of having dinner with His Excellency, the Secretary General of Barkindo of OPEC. He was incredibly open in terms of how worried they are about the lack of spare capacity within OPEC and globally. Can you just touch on why is that so important to the energy markets, and how big of a watershed event is that?
Look, in the past, I remember back in the day, like 10 plus years ago, when we didn't have shale to the same extent, I remember my ex-boss, when I had first started in the oil industry, saying to me, look, you always want OPEC spare capacity to be about 5% of global oil demand, because there's always going to be outages, right? There's, oil just ends up being produced in politically unstable regions, be it Libya, Venezuela, so you need that buffer. 5% is 5 million barrels per day plus right now, right? That's a pipe dream. But then when shale happened, what ended up happening is, lots of commentators were like, oh, we just don't need spare capacity, which has never been our view, right? Like, yes, shale is short cycle, but we've always been big believers that ultimately the shale break-evens are a lot higher than what they were being touted earlier in the decade, last decade, because of, there were different metrics being used by investors. Whereas now, when you're on a more even keel and saying, no, we do want returns, right? It's not just about production growth, then your shale break-evens have gone up. And again, for different reasons, just different constraints and different mindsets, shale just isn't growing as much. So suddenly now people are focusing on spare capacity. Saudi Arabia has mainly been the holder of spare capacity. And the reason it's important is because, again, like I mentioned Ecuador earlier, Libyan production pretty much fluctuates between 0 and 1.1 million barrels per day. You can pick a number on any given day and you probably won't be too wrong. And that's kind of why we've always needed some form of a buffer, because the outage scale for oil is just so much higher than any other commodity market, right? Whether it be because of sanctions, because of just general unrest in a country. And for us, and I'm happy to send you some charts if you want to share it to the listeners afterwards, but global spare capacity, it's fascinating, because when you kind of plug through the latest numbers, we are going to be less than 1% of global oil demand by the end of this year. Like, that is such a critical number to look at. If you had to say to me, just pick one chart that summarizes the oil market, I would just pick that one. Global spare capacity as a percentage of oil demand, right? We are so low. It's basically Saudi Arabia and UAE, between the two of them. 1.5 million barrels per day of spare capacity, if that. Because again, I was in the region in February speaking directly with both the Saudi minister and Kuwait UAE, like these guys directly. It's like they don't have a lot of spare because when prices fell in 2020, they didn't invest either, right? They aren't immune to price changes. Yeah. And that I think is critical because without that buffer, let's say we go down to 1 million barrels per day of spare capacity, Libya goes offline, or something happens in Iraq. Like there's a whole list of, we don't even need political reasons. Imagine the Gulf of Mexico with the hurricane season coming up, right? That's why it's so important. And we just don't have buffers at a time when inventories are already super low.
I want to be very respectful of your time. We had a 30-minute time commitment. So what I'm hearing is that we're subjected to cycle time 5, 6, 7 years plus. Super majors aren't yet in the spending mindset. You referenced $150 billion deficit per annum, which is unbelievable. We've got Saudi Aramco adding capacity. It's going to take them, 5 years to add 1 million barrels per day. Shale growth is constrained by steel and labor. People like myself saying, look at your shares are trading at generational lows, do returns over growth and whatnot. So ultimately means the price has to go high enough to kill demand or rationalize demand, to use your term. Do you have a feel for what price that is? Because we're all struggling with that. Using a simplistic term or a model before you referenced earlier, I think it would get you about $180 if you're 6% of GDP as an oil burden. That feels too high given the inflationary pressures. But the last question I have for you is, do you have a feel for how high oil can go before we reach that point where the burden on the consumer is just too much?
So look, the number you gave is exactly right. It is about $180. But you could argue, and I will say this, we don't need crude prices to go there, right? It's the product prices, it's petrol prices, it's diesel prices, and it's already there. It's $180, and yet we are seeing phenomenal growth in Europe and even in the US. Like we've seen some weakness in the US, but hardly material weakness. Asia is still booming, and Europe, even at these price levels, we're back above pre-2019 levels in May. So clearly, it's not enough, and the reasons they're not enough is partly driven by COVID because people have saved more, and there's just a lot of pent up demand. But also partly because governments are, again, and this is a whole different topic for another time, but if they're serious about energy transition, I have no idea why they're handing out checks or just subsidizing prices at the pump other than wanting to get reelected, because that's completely at odds with one another. That's kind of stoking demand, right? That's why, regardless of what the price is, so crude could easily go to 140, if not higher, but it's the product's price that it's doing the work. And arguably, those prices need to go up even further to offset all these subsidies and tax breaks that we are seeing from the governments. And then it needs to stay there for a good year, if not more, because otherwise you just don't see consumers changing their behavior.
And that is such a critical point to make. So I want to end by relating this back to energy stocks and our thesis. We've just endured the worst drawdown over the past 2 weeks. We have names that have fallen by 30, 35%. And the panic level, in my opinion, in the market now rivals what it was in March of 2020, which at that time oil fell by 50% to $20. Today we're trading almost $110 barrels. So it's a bit mind blowing to me to have to be counseling people. This too shall pass. When we look at the Ninepoint Energy Fund, we estimate that our average holding is discounting an oil price of about $50, trading at a 37% free cash flow yield using $100. And so with their commitment to return the vast majority of that free cash flow back to us, I think Q2 results in the next several weeks will really highlight this. We would be, we are actively, as we're getting inflows every single day, we're going shopping on your behalf and buying stocks, literally trading at 40% plus free cash flow yields at 1.2, 1.3 times enterprise value to cash flow. So Amrita, thank you so much for your time. Amrita, literally, I've called her a rock star of energy gurus. She counsels energy ministers, the largest institutions in the world. So have her to spend 30 minutes with us. We're deeply, deeply appreciative of you and any institutions that are listening. We were the #1 energy fund in the world last year, so we're in 2019, and I credit a lot of that with having to have access to high quality information, and energy aspects is one of our favorite macro firms to use. So for any institutions, I would very much recommend that you look into their service. So with that, we want to be respectful for 30 minutes. Thank you very much for tuning in, and we look forward to holding future conversations in the future. So thank you.